Derek Cam here. Got the quarantine beard in full effect. Hopefully all you guys out there are growing the same. Thank you so much for coming on to the webinar presentation I just gave. I wanted to make this quick little video, put everything together for you, share it to everyone who couldn't make it. I know a lot of people tried to get on there, but they couldn't. But all of those that did come on, there was a lot of people that sent messages thanking me for all the information and how the webinar went really well. So thank you so much for coming on. And once again, we need to all remain positive, whether you're a realtor, mortgage professional, borrower, or just any other person out there going through all this stuff right now. We just need to remain positive. We will get through this. There is a silver lining. So thanks again. Check out the webinar. It's coming right after this little snippet. Hopefully you guys enjoy it. All right, thanks. Guys, we're going to get going. This is your host, Derek Cam, and we're going to be talking about the post-COVID mortgage and a clever credit repairing tactic we all can benefit from. Most of you on this know who I am. Obviously, I'm a mortgage broker, 16-year veteran, been doing this for a long time. I'm very big on social media. Caring about my reputation has been one of my pillars to success. Also an author. I wrote the book, The First Time Homebuyer's Manual to Kicking Ass and Taking Names in Residential Real Estate. So I'm definitely, a pundit. I'm definitely, someone that's in the industry who cares about what's going on and studying the game. So what I'm about to share with you today is what's been going on the insider realm of the lending business. And then at the end, I want to show you guys a credit repair tactic that has given some of my clients a tremendous amount of success. And I truly feel it's something that we all could do, or at least communicate to people that might benefit from it in doing now, since we have an array of latency in the markets. We have people working from home, companies that are not working at top efficiency. So one of those companies being the credit bureaus. So this is the reason why I wanted to call today's webinar in session to kind of go over that. So without further ado, let's jump in. Obviously, we know the dilemma here, right? And I wanted to make a comparison for some of you that are on this call right now that lived through the subprime crisis. This is probably like the last time you felt this way was around that era, in like that 09, 08 type of stretch in history. What's a little different about that crisis versus today's global recession is the fact that the real estate market was just completely saturated with unhealthy mortgages, borrowers that really didn't deserve to be in the homes, and the real estate industry essentially was very superficial. So now with what's going on with COVID-19, it's an entirely different type of crisis, right? For the most part, our real estate industry is healthy, okay? But you have this virus that is killing people, creating fear, quarantining us, quarantining businesses, shutting down businesses, furloughing employees. So it's a whole other type of animal. I think that's really important for us people that are in the industry, that are listening on, and also for people that are listening on right now that are not in the industry, just your regular Joe America borrower, to understand that real estate still is a good investment. And the real estate market still is a pretty strong investment. So there's a difference between what's going on now and what happened, over 10 years ago. So some of those differences I outlined here. Subprime mortgages circa 2007, you had, regular wage earners receiving 100% financing while stating all their income. In today's programs, in our pre-COVID market, right, was primarily only self-employed borrowers were offered this option with a minimum of 25% equity, okay? Back in the subprime era, you had the 228s and the 327 adjustable rate mortgages, which were very common. What this meant was the borrowers were fixed for 2 years, 3-year periods, and then after that, the rate would unlock and float, which is essentially what brought our country down, right? Because you had interest only on those. Some of those even were ballooning payments, meaning that clients had to pay the whole mortgage in full, refi, sell, or get out of the mortgage when it ballooned. These past years, we've been primarily seeing 30-year fixed, FHA, conventional mortgage programs, okay? More conservative, stable type of products. Another thing that we should be hanging our hat on in positivity here, that it's a whole nother animal compared to what it was in the subprime era. You also had the notorious option arm, right? For some of you guys that remember back in those eras, right? The negative amortization or neg-am loans, which rapidly put people's home values underneath their mortgage balances, which turned the real estate industry upside down, created tons of foreclosures, tons of short sales. Okay, these types of loans don't even exist anymore. So this is kind of like what I wanted to preface the meeting by just showing you the difference of where our real estate market is as far as a lending aspect is, and in comparison to where it was during the crisis, the financial crisis. What does this mean to the real estate values in the real estate industry? Well, it means that the overall health of the real estate industry wasn't in question here. The majority of borrowers who took home ownership in the past years truly qualified, even the ones that were higher risk borrowers, i.e. borrowers with high debt to income ratios, deals with the use of multiple non-occupying co-borrowers. For most of you that know me, I've done a lot of business in the Latino community. Anybody that's privy to that industry knows that ecosystem, moreover, knows that it's a lot of co-signing. It's a lot of non-occupying co-borrowers, family, cousins, friends, co-signing for one another, trying to help one another get into the property, right? So these types of loans and programs, you're going to see a tightening on it. You're already seeing a tightening on it. Okay, debt to income ratios are coming down on FHA mortgages. You're going to see more and more strict guidelines being enrolled. Reserve requirements are needed now with FHA. Okay, higher credit scores. Okay, even deals that were in the pipeline and approved months ago, that if they fall into these categories where they're not meeting the requirements, you're going to see a lot of pushback from lenders. This is an issue that we're going to be coming across as industry professionals. So it's something to take note of. Okay, even with the crisis taking on full effect, home values should not be affected too much like in the financial crisis over 10 years ago. There could be some major dips in certain markets, but there is a buyer demand that will follow after COVID is tamed with a vaccine. Okay, I truly believe that. I mean, you're going to see some values coming down. You're going to see less and less sellers feeling comfortable with open houses. It's going to affect our market. There is going to be some dips in the near future. However, there is still a large buying demand. Okay, so once this COVID stuff is tamed, okay, we will start seeing some normalization in the markets again. So don't lose the faith, guys. Keep the faith, okay? My honest forecast is that the real estate industry will prosper, okay? It will prosper. Okay, it's still a great time to purchase. It still will be a great time to purchase in the next couple of months. People will still get a ton of value out of owning real estate here in New York or wherever in the country for that matter, okay? Okay, so what's going on with the mortgage rate volatility, right? Anybody who has a pulse and is in our industry knows what's going on. Every day you go on Google, if like me, and if you're Googling mortgage rates, mortgage news, what are you seeing? Super low interest rates disappear from mortgage comparison. That was 3 weeks ago. The most volatile day for mortgages. That was 2 weeks ago. Mortgage refinance applications spike 79% as homeowners rush to take advantage of lower rates. That was 3 weeks ago. Okay. Mortgage rates increased this week despite the coronavirus turmoil. That was 2 weeks ago. Okay. So you have all this stuff going on. Why is it? Why are we having this volatility? And this is what I put together today for you guys. Okay. What the federal government thought should have happened with their massive buying of MBSs, right? Mortgage-backed securities. That's what MBSs are, okay, from a traditional standpoint. Okay, you have the Fed buying the mortgage-backed securities, hundreds of billions of dollars of worth, mind you, okay, which is essentially going to do what? It's going to drive up the prices of mortgage-backed securities, which then in turn, okay, from a traditional standpoint, lowers interest rates. It lowers mortgage rates, which then in turn, as a lender, I'm able to go communicate to my agents, to my clients, and borrowers are happy to refinance. They're happy to get out, get pre-approved, go look at homes because rates are low. They can afford the payments. And that's what the federal government, okay, had intended with their massive purchasing of MBSs. But that's not what happened. And that's not what a lot of people understand. And then the next slide, I'm going to show you what's going on, right? Unfortunately, what happened, it was an opposite effect. The Fed was dumping hundreds of billions of dollars of MBSs into the market, driving up the prices of mortgage-backed securities. However, interest rates also were rising at times. They were going down, they were rising at times. And what happens? We have a lot of pissed off and confused clients, mortgage lenders, and real estate agents alike, okay? The reason for this, and we're going to talk about the reason number one, is capacity issues, okay? These are simple capacity issues. Mortgage rates hit record lows. Everyone wants to refinance, okay? Now the lender becomes overwhelmed with more applications and they can't handle it, so they need to hire more people, more staff to underwrite these applications, okay? What does that do? It forces the lenders to raise the rates to stop the applications from coming in. What do you have? Confusion, pissed off people not understanding what's going on, not even the federal government for that matter. Reason number two of the mortgage rate volatility are liquidity issues, okay? Below is what a stable example of what should be happening, okay? You as the borrower, you lock your rate on April 1st for 3.5%. Your mortgage lender then promises you that upon closing, you will see that rate, okay? However, what you need to understand is that rate is not essentially locked when you look at it from a mortgage lender investment standpoint. They're essentially promising you that rate, and you will get that rate, okay? You will get that rate, and they're promising you as long as you sign the rate lock agreement. Now, what happens on the back end is that you have the lenders that are trading this paper, okay, referred to as hedging, okay, to protect their position and deliver on that promise to you, okay, regardless of market conditions. Okay, you can see how I highlighted regardless of market conditions in red, because the borrowers, after signing their rate lock agreements, will receive the rate, okay? But what's happening is as follows, okay? The Fed, since they purchased such a massive amount of mortgage-backed securities so rapidly, the lenders, when they're hedging, it's creating margin calls on their short positions, because the lenders, they do a short position, they do a long position. So no matter where the market moves in that 15-day, 30-day, 45-day, 60-day lock, they're going to even it out, okay, and try to not take as much of a loss and make out, okay? But what's happening is that when they're losing on their short positions, okay, and as you can see Batman smacking Robin there, the broker dealer is saying, no, you need to pay me now, okay? You can't make it up on other loans. You need to pay me now. So lenders are now having to cough up major money to their broker dealers, which is causing major liquidity issues nationwide, okay? Major liquidity issues, okay? What does this do? This then drives interest rates up, okay? And then we have what? We have confusion, we have pissed off borrowers, you can see by the image there, right? Everybody holding the flames. All right. Now, here's another reason, okay? Forbearance agreements. So probably the most important reason for mortgage rate volatility right now, and just in the lending landscape to begin with, just you're going to see lots and lots of lenders pull back, deny loans. Some lenders have even imploded. I had some personal friends at Impact that are no longer working. My associate at New Res Wholesale has stopped taking submissions because of the fear of forbearance agreements, right? What these clients don't realize is that every lender is different. Every type of forbearance agreement is going to be different. That's why it's important that if you're a borrower right now listening on, you need to be reaching out to your lender and get stuff in writing to know just exactly what does your forbearance agreement entail. Because if you don't make your payments for the next 3 months, and then come July, you're ballooning and you got to pay your $3,000 a month mortgage for the past 3 months, that's going to be a massive issue, okay? What's happening with these forbearance agreements, it will be creating a servicing issue nightmare for lenders, because regardless if you pay your mortgage, your servicing company needs to pay for you regardless. They promise the investors that are backing these mortgages that you will be flush, that the mortgage will be paid, okay? So if you're not paying, they have to pay. And if they run out of money, okay, going back to the liquidity issues that we just spoke about, it's going to fall on Fannie Mae and Freddie Mac. And then if they can't handle it, it's going to fall on the US Treasury. This is going to become a major issue, okay? So if there's anything you take away from this call, please communicate to people about the forbearance agreements, that they understand what's going on, okay? And if you can make your mortgage payments, you're way better off doing that for the economy and the industry as a whole, okay? Not a lot of people understand that. There is a silver lining, however, okay? Mortgage rates near record low. Here's why it's a good idea to refinance. This was a day ago, okay? Mortgage rates on April 6th, rates moved down a day ago. Mortgage rates will fall sharply as the Federal Reserve brings stability to the mortgage market. This is a week ago. So as you can see, the recent bulletins, the recent headlines out there is that stuff is starting to stabilize a little with our industry, okay? Rates will come down, okay? Not one expert in the industry feel rates will be going up. So right now, my position as a lender for my clients is floating. I'm floating all of my mortgages out there because I am long on the industry. I am long on the markets. I feel that the rates will come down. They will, okay? And a lot of industry experts feel the same way, okay? And then, of course, the silver bullet, keeping our credit scores as high as possible, right? Lower the score, higher the rate. Higher the score, lower the rate, okay? This is what we need to do. And so on that note, I'm going to get right into the topic and the core underlining subject of today's webinar, and that is, okay, a credit repair trick that we can delete anything off our credit report. All right, so the one thing I want to discuss here is the Section 609 of the FCRA, okay, Fair Credit Reporting Act. All right, we're going to get into step one, accessing copies of your free credit report. There's a way to do this. All right, me as your lender or any lender for that matter that sends you a tri-merge report from the mortgage company, it's not the way to go about it. It's not the information that you want to go off of in order to do this method to get deletions. It's not the proper way. Okay, when you get step two, receipt of your reports, we're going to take a look at that. And step three, mailing and fielding the letters and actually put in the work, staying on top of this to see through the results. Okay, so Section 609. The FCRA states bureaus must verify all information that they get from banks, credit card companies before it's put on your credit report. The CRAs or credit reporting agencies must have the original signed documents from when you opened your credit card or got your loan, okay? Hence the capitalization of original signed documents. Since verifying millions of people's original contracts would be disastrous for speed and efficiency, this creates loopholes for the opportunity. Hence why I'm bringing this up right now, okay? Everything is dragging ass. If there's any time to jump in, roll your sleeves up, and there's like the old saying goes, there's no good defense like a good offense, right? So now's the time to attack. Credit bureaus will try to verify electronically with the creditors, to which they will most likely say yes, but are they providing the original contracts? That's the key thing here. That's our hook. If the CRAs can't provide this to us, they are in violation of the FCRA. No one knows this loophole other than industry insiders and solid credit repair people that get those big results, okay? What's important? Section 609 of the FCRA does not care whether the negative count is valid. That's very important. This is not the Section 609 only cares as to whether or not the CRA is compliant. Okay, so most people feel like, oh well, it is my debt. Well, I don't want to say it's not my debt. I'm going to be committing fraud. No, you're not. We're not debating that. We're not disputing the validity of it. We're disputing whether or not they're compliant. That's the key thing here. That's the key thing. We're disputing whether or not they did their compliance by law. They didn't, take the freaking crap off my credit report. That's simple. All right. So essentially, if they are reporting something, they need to, by law, produce the original contract. Okay. Step one, accessing copies of your free credit reports. Okay. Like I said, using your lender, using myself, it's not the way to do it. Our government allows a free credit report from Experian, Equifax, and TransUnion once a year. Never request the reports online. We order by mail, we receive by mail, we dispute by mail. Bottom line, we need to first order the report within 12 months before we dispute it. So obviously all of us, if we're ever going to jump on this train, we're going to go at it now. Anybody watching this in the next couple of weeks to months, you jump on it immediately and this won't affect you, right? We need to send out the letter, number 10 business envelope with a first class stamp. The request will be processed within 15 days from the time they receive the letter, okay? We will request all 3 credit bureaus at the same time on one letter. Let's take a look at what the structure of that looks like. So it's going to look like something like this, okay? Name, address, city, state, zip at the top. That address is the actual legitimate address you're going to be mailing it out to. Date, dear credit representative, please send me my 3 reports. Sincerely, signature, okay? And that's what it's going to look like. Super important, make sure to include a copy of your driver's license, social security card, and a utility bill that provides proof of name and address. We don't want to give them any leg to stand on here, okay? When we send this stuff out, they're going to try to come up with scapegoats and excuses not to process this or to rebuttal it. So we have everything ponied and everything buttoned up the way it should be, okay? We're going to want to send the letter, first class stamp, number 10 business envelope, so it gets processed in 15 days. We do this via snail mail because by phone or email can give the creditors the argument that anyone could have done this, and there are imposters involved, right? It's not you that did it, it was somebody else. By snail mailing this way, it protects us and keeps us compliant with our argument and request for the deletion. Step 2, receipt of our records. So we dispute the negative item only with the bureaus that report it. Very important. So when you send these letters out, okay, TransUnion might not report it, but only Experian and Equifax. Well, don't write the letter to TransUnion and open up an eyebrow there. You look and you see where the negative items are, at what bureaus. If all 3 bureaus are reporting it, you attack at all 3 bureaus. If only 1 bureau is reporting it, then you only go to that 1 bureau. So having some organizational skills and being on top of this is important, okay? And if you're going to do it yourself to save money, then you're going to want to have some organization set up and not be jumping all over the place and losing paperwork, okay? Here's where we also look to see where the physical addresses of the credit bureaus are located. We will need this in order to mail our dispute letters out, and this will have the most up-to-date info, so there's no holdup on sending to the wrong address. Another reason why we do it via snail mail. You do this via email, you do this via telephone, you ain't gonna get the information. You do it by snail mail, by law, they gotta show you where the right address is so that you can send this stuff out and get stuff done fast. All right, now we start highlighting all the negative items on these reports at each bureau separately. Okay, let's take a look at those formats. Here is level 1 dispute letter, courtesy of Brandon Weaver, by the way. So I'm just going to give a shout out to him. Brandon's whole system is just, he breaks it down and he's amazing. So, you know, this is definitely warrants, you know, merit to him and to his system. So I just want to throw that out there and definitely give him that exposure. So level 1 dispute letter template. Okay, I have all these for you guys too on the Word docs that are attached below. There should be below a link below in the chat section area where you can download these. But essentially, you want to dial in your information here. Okay, I'm not going to read it through line by line, but you want to the T, fill this out. Okay, line by line, each creditor once you get your credit reports back from the credit bureaus. Okay, as you can see, let's go back here. As you can see here, all the areas where you fill in, you sign, and then obviously you want to bring this to a notary and get this notarized. Very, very, very important. And then at the bottom, you put in a copy of your social security card, copy of your driver's license, and once again, a copy of your utility bill. Okay. So what you have here is you have the level 2 dispute letter. Okay. So depending on what they come back to you with, the answer, you're going to know what dispute letter to answer with, right? But essentially, these dispute letters run you through the gamut, okay, of what you need to do in a systematic way to get this stuff deleted. And like I said, you know, right now things are so upside down out there. Okay, the process and protocol, these companies are in such fear. It's a great time to play these loopholes when everything's been just so slowed up in the market. Okay, guys. So that's it. All right. To quote Winston Churchill, if you're going through hell, keep going. I mean, we're all going through it. I know I'm locked up over here right now with my wife. You know, we're trying to remain positive, trying to be proactive, you know, trying to put out content like this right now to my clients and to my referral partners and family and friends. And I suggest that anybody out there, you know, if you're in the, you know, the servicing industry like me, and you're in the retail industry for the matter, it's so important that we're out there and we're talking to our networks. We're trying to remain positive, trying to do the, you know, the things that we can do that we have control over, so we don't let this virus and this recession set us back. You know, we keep barreling forward, and we'll get past it all. So once again, if you found value in this presentation, you know, I will have a recorded copy of this, so I will post it on my social media. And I would say just, you know, share it with who you feel, you know, would get value out of it. And once again, you know, I'll wait to see if any questions come through. Let me see here where we're at. We still got 11 attendees on. It's great. Shondell, how you doing? Danielle Diaz, Coachy, what's up, brother? Shalene's here. Margaret's here. Okay, guys, thank you for all coming on and you know, taking the time out of your day to listen to what I had to say about everything going on in the industry. So I really, really appreciate that. Let me see here if there's anything else. So yeah, any questions you guys have, feel free. You could PM me, and I'll make sure to get back to you. But this is essentially where we're at. Expect a lot of volatility in the next couple of weeks. Okay, with mortgage lending, with interest rates, but there is silver lining, and everybody hang in there, and we'll get through this all together. All right, guys. So thank you.